Welcome to the Daily Block, the top events in the past day in crypto and why they matter, served with a side of chaos and caffeine. FOMC priced for a 25 BPS cut, market on edge. The market is betting the Fed cuts 25 basis points today, and traders have been stacking positions and options into the seams of Powell's press conference. Bitcoin, Ethereum, and a bunch of altcoins have been creeping into key technical levels as ETF flows into spot. Bitcoin remain heavy and directional. Expect volatility ramps around the announcement and the ensuing guidance about future cuts, because traders are already levered to a narrative of easier money. Why it matters for crypto investing. A genuine cut or a dovish tone typically sends institutional and retail wallet flows into risk assets and spot Bitcoin ETFs, amplifying rally chances. Risk or counterpoint, even a slightly less dovish message or talk of patience can trigger an immediate sell the news unwind, which is exactly the kind of event-driven liquidity shock that hurts leveraged positions. Chainalysis shows tokenized money markets and Bitcoin ETFs driving US adoptions. Chainalysis data shows tokenized treasury-backed money market funds ballooned from roughly $2 billion to over $7 billion in AUM in a year, while global Bitcoin ETF assets hover near $179.5 billion, with the US controlling about $120 billion of that. Institutional rails plus tokenized cash-like products are slithering into traditional portfolios, making crypto more of a plumbing play for smart money instead of just a speculative corner. Why it matters for crypto investing. Those institutional on-ramps create persistent, big-ticket flows and raise correlation with macro markets, which means trends can stick for weeks rather than minutes. Risk or counterpoint. Heavy institutional correlation also means crypto will catch cold when macro risks flare, reducing the diversification thesis for some portfolios. PayPal expands P2P crypto transfers in the US. PayPal is rolling out peer-to-peer crypto transfers in the US for Bitcoin, Ethereum, and its PIUSD stablecoin, making it possible to send and receive crypto inside PayPal, Venmo, and two compatible wallets, plus a PayPal Links feature for payment requests. This tweaks the onboarding funnel by collapsing custody and transfer friction for hundreds of millions of users into a single familiar app experience. Why it matters for crypto investing. Easier mainstream payment rails mean more retail on-chain activity and episodic volume spikes, which translate into price momentum and higher short-term liquidity. Risk or counterpoint. Centralized rails can also centralize control and privacy concerns, and any regulatory clampdown on these features could reverse uptake quickly. Coinbase asks DOGE to step in against state patchwork. Coinbase filed a petition asking the Department of Justice to intervene, arguing that inconsistent state enforcement and licensing regimes are wrecking a national market and that federal preemption is required. The exchange is begging for a single federal rulebook instead of battling 50 different regulators, which would simplify operations and reduce legal uncertainty. Why it matters for crypto investing. Federal preemption would cut regulatory tail risk for US exchanges and institutional players and could steer liquidity and product innovation back on shore. Risk or counterpoint. Political reality is messy, and a federal solution could still introduce new constraints. Meanwhile, state regulators will keep enforcing in the gaps, so the relief may be partial and slow. Dogecoin ETF launch fever and a whale accumulation. As the first US Dogecoin ETFs get ready to list, on-chain data shows whales scooped about 680 million Doge in the run-up, and derivatives open interest has spiked. Institutional and corporate buying programs plus ETF structuring are pulling structured capital toward what used to be purely meme territory. Why it matters for crypto investing. ETFs translate retail narratives into institutional addressable demand, and for a token with thin liquidity relative to interest, that can trigger outsized squeezes and violent short squeezes. Risk or counterpoint. Meme dynamics are famously fickle, and if ETF flows disappoint or whale selling begins, Doge can drop harder than it rose. Ethereum unstaking exit queue goes parabolic. The Unstake exit queue for Ethereum has blown past about 2.6 million ETH, roughly $12 billion, creating wait times north of 40 days and forming the largest validator Unstake backlog ever seen. That backlog represents latent sell pressure waiting for fiat conversions, even while some institutional treasuries and staking-like demand are absorbing supply. Why it matters for crypto investing. If large tranches of unstaked ETH start hitting spot markets at the same time macro demand softens, it could exacerbate sharp corrections in ETH. Risk or counterpoint. Not all queued ETH becomes instant sell pressure, as many validators unstake for liquidity management rather than an intent to dump, and institutional buying could offset outflows. Mantle upgrades to a ZK rollup. MNT prints a new ETH. Mantle finished a mainnet upgrade, turning it into a ZK rollup using OP. Succinct proofs. TVL surged from roughly 218 million to over 2 billion, and MNT pumped to a fresh all-time high near $1.71. The tech shift lowered fees and finality times, instantly making Mantle more attractive for apps and traders hunting low-cost rails. Why it matters for crypto investing. Protocol upgrades that materially improve UX and economics often trigger quick capital rotation and retail FOMO, creating clean momentum setups for altcoins. Risk or counterpoint. Fast inflows can mean fast outflows, and if application activity fails to stick or yields normalize, the token can give back gains just as fast. BitGo. Europe wins BaFin approval to expand into trading. BitGo Europe scored BaFin approval to expand from custody and staking into regulated OTC and electronic crypto trading across the EU, layering MiCA compliance with local German oversight. This gives institutional clients a single regulated stack for custody, trading, and staking, which eases compliance headaches and execution risk. Why it matters for crypto investing. Integrated regulated services lower barriers for institutions to allocate, which should increase flows into ETPs, treasuries, and primary markets in Europe. Risk or counterpoint. Approvals ease access but do not guarantee demand, and Europe's patchwork of rules plus global capital flows will still influence how much volume actually migrates. Quick reality-checked wrap. All 8 of these stories are connected by a single theme. Structural liquidity is increasing, while event-driven volatility remains high. Institutional rails, ETFs, and tokenized cash products are making crypto more of a macro beta play, while payments rails and tech upgrades keep retail involved and impulsive. Traders should be watching flows, exchange balances, and derivatives. Open interest precisely because those metrics now move price as much as narratives do. Hit subscribe for daily raw takes and market dirt, so the next time the Fed coughs, 2 of us won't be screaming into the void alone. That's today in crypto, where the gains are imaginary and the pain is real.